Hey everyone, welcome to the first market update recording. I've been previously doing these on webinars, and just after some feedback and realization that is just too challenging for clients to make a specific time on a webinar. So I'm just going to be doing these these videos and then sending them out to you, and we'll be doing them once a month. So that way it kind of keeps you updated and try to keep you informed on what's happening in the market and my take and then just so you can have that education piece and just kind of, know from my perspective what I would say is going on. So, this is just to keep you informed. Again, we'll be doing them monthly and, talk about what's going on. So let's always start here with just who Selah is. So Selah was founded in 2019 with a goal of bringing confidence and organization to people's financial life through education, stewardship, and empowering wise decision making. So that is one of the points of this market update loom. It's just for you to keep that education and understanding of what's happening so you can have that good decision making with what's happening in markets. I'm a holistic wealth management and planning firm located in California, but serving clients nationwide. So if you are not a client and you are listening to this and you are not in California, don't worry. I do have clients outside of California and other states as well. And I serve mostly millennials, families in all life stages, and retirees. So just a little bit about myself and the business here. So what we're going to do today is just a market update, which always, I kind of always include just a quick look, call it a quick look of where the market is right now, and what's been happening lately. Year to date, look at those numbers. We're going to talk about markets after rate hikes. You have been inundated and talking constantly about rate hikes and inflation. So we've talked a lot about, what happens during rate hikes in markets, but now we're going to talk about what happens after. Because we're maybe starting to turn that corner. And then cash on the sidelines and what's going on there and what that means for you and maybe your portfolio and all of that. So, all right, here's this quick look. Let's look here. We have the S&P 500 year to date return of 14.05%. Here at the top here, you have the NASDAQ with a return of 27.03% year to date. And then you have the Dow Jones lagging well behind both of those. These are not the highs. If you've listened to other webinars before, these numbers have been a little bit higher. We're at least a few percentage points now off the highs for both the S&P and the NASDAQ for year to date. If you look down here, the reason, those markets indexes are performing better would be for this information technology and communication services, 34.83% and 40.45%, both doing pretty well year to date so far after a really, really rough year last year. But again, like I said, off their highs of where they have been previously for this year. But as you can see, week ending, and I'm sorry, I should have said at the beginning, this is as of last week, as of last Friday, 9/22. So this is not current as of I'm recording this on 9/27 today, Wednesday. This chart is as of last Friday, but you can see as of last week, week ending was down 2.77% in the S&P, and the NASDAQ down almost 3.62% last week. And unfortunately more this week, as there's just been some more volatility as people are still digesting rate hikes and inflation and all of that. So markets after rate hikes. I feel like it's felt like a long time getting to this point of like what happens after the rate hike. We've been talking about so much of what happens during rate hikes, and we've felt and seen now last year what happens, especially during rate hikes. We had both equities and bonds down and fixed income down in the same year because of the rate hikes. So that was real fun. So now we're like, okay, what's happening after? What can we get to that next phase, right? So you have, I wanted to show you this chart. What happens after the Fed ends their rate hikes. So this chart is showing you the last four cycles, so the last four times we've gone through raising rates, due to the Fed hiking rates, what has happened in the 1 year following the final Fed hike and the 5 years following the final Fed hike. And notice the important thing on here, that this is not saying after the first Fed cut. This is actually after the final Fed hike. So something to know and remember about markets. And if you've talk to me, I will remind you often that markets are a forward-facing it's a forward-facing being. It is looking 8 months plus out into advance in the future and assessing what's happening. That's what it's investing. That's what it's looking to when the markets are going up and down. So it will react to day to day to new information, obviously, but it's really how that information is affecting its future. And so a lot of times people are very surprised by this, that the market actually goes up so much. So you see the S&P 500 index, 16.2% fall in the first year following the final Fed hike. But people are like, but not when they're cutting rates. It's actually when the final hike. Well, that's because there's finally certainty in the market again. The market knows the Feds are done raising rates. We're past that point. We're going to move into this new cycle, and it's looking forward. So that's always surprising for people to understand that it's after the Fed hike. But that is an important thing to note, that if you kind of wait till the first Fed cut with some different investing strategies, you're gonna miss out on a lot. A lot of it happens after that first Fed hike. So here you go. Here, 16.2%. Bloomberg U.S. Aggregate Index 10.1%, 14.2% on the 60-40 blend. So showing you like your normal kind of balanced portfolio for a lot of people, and then a 4.7% on a U.S. 3-month T-bill. And then you have the 5 years following the final Fed hike. So a lot of that growth is in that first year. The years following aren't bad, but a big amount in that first year. So that's really important to remember and to consider. So just some key takeaways. No one knows when the Fed will stop raising interest rates. We don't have that crystal ball. We don't know that. But we do know that both the market and the Fed itself project key policy rate to peak near current levels. So we know we're almost there. May there be another rate hike? There might be, depending on how inflation numbers look, but we know we're almost there. We've gone through the worst of it. We're about to turn that corner. We know that the Fed is hawkish on how long rates will need to stay elevated. We heard him talk about that last week in his meeting. He's not going to give any concrete answers. A lot of it is going to depend on the data. They don't know exactly when they'll start being able to lower those interest rates. But the projection are that the decline of around 100 basis points by the end of 2024. So by the end of next year, about 100 basis points rate lower, so 1% lower than where it currently is. So that would mean by the end of next year, people think that the rate decline will start to happen. Rates will start to be lowered. Could it be before that? Maybe, probably not. But we don't know when that last rate hike will come. All of this is data dependent, and it really does depend on what that's looking at or what happens there. But this is kind of the base projection of where people see this falling. And history has showed us that cash has decayed when Fed hikes end. So in the 18 months after Fed ended hikes, in the last 4 cycles, yields on cash-like investments have traditionally decayed very rapidly, with a 3-month Treasury yield falling an average of 2.5%. That's in that first 18 months. So that happens pretty quickly, and that's something that's important to consider. And these things happen again, like I was saying before, they happen after the last rate hike, not after the first cut. So we see big changes in that market after that last rate hike, which is good news for us because we are almost there, and that would be nice after the market being, feel like it's going sideways for forever. So what about cash on the sidelines? What does this mean for cash on the sidelines? Or maybe you've heard people talk about there is a ton of cash on the sidelines. So what's going on there, and what does this all mean? So I wanted to show you this chart here. This is the ICI money market fund assets in trillions. And just want to show you what's happening here. So you see different cash peaks in different market environments. So if you look back to the financial crisis, 2007, 2009, you see a cash peak of January 9th, 2009. That was finally when cash peaked in money markets, only a couple months actually before the S&P trough, before the low in the market, which was March 9th of 2009. So you see that cash peak right before that bottom in the market. For the pandemic, you actually see very still closely correlated and close together, but you see the bottom in the market first before that cash peak, and then a decline in cash. And that's here, the very rapid decline in cash after that cash peak and that market bottom. So here, we don't know where this cash peak is yet. And this is actually this chart is as of August 11th. But as of September 6th, cash has hit that 5.6 trillion mark. So a little higher than this chart shows here. So we don't know where the cash peak is yet, because obviously we're not on the other side of this, but we do know that shortly around a cash peak and a bottom in the market, and we don't know, the bottom so far was October of last year. And so this could be a little bigger gap, maybe between the cash peak and the bottom of the market, than these last ones show, or if we have more volatility to come to get that bottom. But the reality is that cash peak happens in that bottom of near that bottom of the market, and then there's a quick decline in cash after that. And we understand that, right? We understand that why in volatile markets are people fleeing to cash. One, especially right now, we had interest rates going up and yields higher. So people are fleeing to cash because it's an attractive investment. I mean, they've been able to get, if I'm getting 5 or 6% in my high yield savings account, that's great. I'd rather do that than be in this market that just doesn't seem to be doing much of anything. And again, for this year, the market has done, you've seen on the chart, 14.05% S&P. That's decent, but it's felt that way, right? It's just felt like a lot of back and forth. And so everyone's waiting for just a final kind of like turnaround to move beyond this. And so cash feels like a place to be for now. Or it's just if you have a lot of a future uncertainty in the market, like there's just still a lot of uncertainty. There's a lot of concerns that clients have that I talk to, that people have that I talk to that are like, well, I don't know where this is going. This feels like it's going to get worse before it gets better. And so I want to be in cash. So, it's fear-based, but it seems like an attractive investment. But then the problem becomes, right, when you're heavy in cash, if you have moved a lot of money into money market or high yield savings or something like that, cash-like investment, the problem becomes how and when do you get out? Because we see these are rapid declines afterwards, after those bottoms. And people normally when they're getting into cash, it's for that safety, but they like to time the market. They're trying to well, let me go here for a little while, get this 5%, and then we'll move back when the market turns around. Okay, so let's look at that. So here, total returns after the troughs, like what has happened previously in the S&P, okay, during the global financial crisis, in the 3 months after the trough of March 9th, 2009, the market had a return of 40% after the pandemic, in the 3 months after the trough of March 23rd, 2020, 41%. Okay. Then you look at 6-month returns, 55% and 46%. That's a lot, right? Those are really big returns. And I get it. The decline was steep before that. So it's just trying to make its way back. But those are big jumps in the market right after cash peaks, right after trough. So if you are in cash and you're trying to time your way back into that, you could miss a lot of that by what we just talked about. A lot of people they're going to, like if you're trying to do this yourself, you're like, I'm staying in cash until I see the first rate cut. Well, you're late at that point. You've already missed a lot of these returns that have come back into the market if you wait till that first rate cut. So it actually happens earlier than you think. And so it always comes back to the points I just want to make with you today. It always comes back to, again, you'll hear me say it over and over again, that it is time in the market, not timing the market. And that historically, that has won over time. Time in the market, not timing it. Okay, but here's the problem. I'm already in cash, so now I have to time it, right? This is you've already put a lot in cash, and now you are timing it. So, what are, what's the strategy around that? And, with the Fed, with what we know that the Fed is going to start cooling things here soon, because we're getting to those peak Fed funds rate, we know things are going to start to change. So we know that. And then we know the market has really quick rebounds. So we just looked at that. We just talked about that. Market has really quick rebounds. And actually the biggest days in the market often come at the bottom. And if you miss those big days, you miss out on a huge percent of the return for that year. So the opportunity cost is really high by staying in cash. You can have your opportunity cost is really high. It's great right now. You have good yields, but when this market turns around, look at how much cash there is sitting on the sidelines. This is a very bullish, contrarian signal for investors. That is a ton of cash. At some point, that cash is coming back in this market. And when this cash comes back into this market, this thing is turning around fast, right? So that would be like, we kind of talked a little bit, if you were at my client event in Washington, we talked about how we talked about this bullish signal, and we talked about how Capital Group right now believes that it will be a mild, if we hit that recession, it's a milder than normal recession, but a very quick recovery. This is something they're looking at of why they think it's a quick recovery, because there is so much cash sitting on the sidelines ready to go back into this market that is going to boost this thing up pretty quickly when we start to get some good news. Okay, so if this is you have a lot in cash, you're not really quite sure how to get back into the market, I would say a few tips that I would want to, kind of point out to you. So one, I would say you need to really revisit your goals. Revisit what your long-term goals are. So not your short-term, what are your long-term goals for your investments and for your money? You need to revisit that. You need to figure that out. If you haven't even done it yet, you need to figure it out. Because if you are young and your long-term goals, trying to retire at a certain age or whatever your goals may be, it would probably make a lot more sense in most cases that you get this money out of cash and you get it back into the market, because you can't afford really to lose out on beginning of markets that may make sense to you. So you really need to revisit your goals. And take a look at that. And I would say also take a look at your risk tolerance. So readjust or reassess your risk tolerance. If you have moved very heavy money market and very heavy cash, you're going to be more than likely, unless you're an incredibly conservative investor, you're going to be out of whack in your risk tolerance, because cash is so conservative, and that's going to play a role and change your long-term outcome on your money in the long run. So I would say reassess your risk tolerance and see if you're out of whack. Because you have so much cash, you should be invested closer to, if you work with me, you have risk numbers, you should be invested close to a 75, but you're a 55 because you have so much cash. That's going to really take a long-term effect on your portfolio. You need to do some rebalancing to get yourself back to your overall risk category that you should be in for what your long-term goals are. And then, I would say things like, depending on how much you have, you might want to consider dollar cost averaging back out of cash into the market. So you're not trying to time it at a specific time, but that this, after rate hikes, there's all this growth historically. We don't know if that will happen again, but historically that's what it's happened in the past. So that's what we can hope to happen next. And so, okay, let's start dollar cost averaging this much every month to get back in consistently investing your cash. Maybe it's 10% per month you're putting over the next 10 months that you're putting back into the market, just to take that pressure off of trying to time this thing. But there are strategies and ways that I would recommend that you start getting this back in. And if you don't know that, then reach out and let's have a conversation about it and figure out what makes most sense for you. But definitely time to consider a rebalance if you've gotten heavy in cash, just based off these numbers and based off what I've shown you, what has happened in markets following bottoms, which have come really near cash peaks. That it may be time to, the opportunity cost, it may be too great for you to stay in cash. And I understand investing can be so emotional, and so hard to separate your emotions from data and historical markets and things that we look at. And that is why I like to keep these charts in front of you and why I like to give you these market updates. To kind of help give you a different perspective on what I'm looking at, what, analysis is out there of what we can hope to be expecting in these future markets, rather than trying to, if you don't have this perspective, then you're often going to make emotional decisions about your money, which is what we want to try to stay away from as investors, because, like I said, market is forward facing. So your emotional decisions are going to be late. They're always going to be late. You're going to be reacting to what you see the market doing rather than what you know should be coming in the market. So that's what I wanted to show you today. I hope that is helpful. Again, reach out if you have any questions. I forgot about this. I'm sorry. So kind of the case for deploying cash in equities. I want to show, like, if you're deploying, we kind of said how to get it rebalanced back in, maybe dollar costing averaging out of cash. But this is kind of the case for equities versus bonds. And again, this is going to depend on your risk tolerance. So it's not really a one or the other, but actually where you're out of balance is what we would need to look at. But to get back into equities, the case for that is, a balanced strategy could be more attractive for more cautious investors. A balanced fund tends to hold more defensive positions in dividend paying stocks and high quality bonds, which is why you may want to get into equities from your cash. Dividends have had an important impact on long-term portfolio outcomes, and dividend payers across a range of sectors have contributed to total return over time. Dividends can be a real good friend during down, when markets are volatile and down. You still get those consistent dividends as well. And many investors may not hold enough dividend payers. So like if this is something you don't have enough in your portfolio, now it's time to maybe deploy cash towards this to rebalance you better into more dividend equities. But maybe you need to deploy into more bonds. So, bonds have historically benefited as the Fed ended its rate hiking cycle, with the best returns coming in the months leading up to, catch that, and immediately following the last rate hike. So, that is when bonds have done really well. Investors who waited for the Fed to cut missed a good portion of the results. So, like I said a few times in this market update, is you don't wait for the market to happen, because when you wait for the Fed and you wait for that first cut, you're going to miss a lot. So investors should consider redeploying cash to bonds as the Fed shifts to normalize the economic environment. So that is something you could consider. And a lot of this is going to depend more on where you are out of balance in your portfolio, which is something we can take a look at. But that's kind of the case for each of those. So just a little bit about LPL. I am independent, and that's why you see my DBA as Selah Portfolios and Planning, but my broker dealer that I go through is LPL Financial. Linsco Private Ledger is what that stands for. LPL is the largest independent broker-dealer in the U.S. There are no proprietary products that LPL has, so they don't have their own funds that they want me to sell to you, which means that I am able to be a true fiduciary to you as the client and always act in your best interest of what investments are better for you, not what maybe would pay me as in other situations. So they are independent, no proprietary products. You see there about some SIPC insurance and protection for you when you are with LPL, and my securities registration is held through LPL Financial. And here are some just disclosures from LPL. Again, something to remind you is that historical markets does not mean what is going to happen. So don't ever take that what I'm showing you, what has happened previously, means it will happen again. But we can look at it. Just one thing we can do with investing is look historically. This is what has happened in the past. So it's a good, expectation that we could hope to be coming for us, around the corner. And then ways to get in touch with me if you have more questions or if you're interested in working together: my email, my office phone number, website, Instagram, Facebook, YouTube channel, and the Confident Dollar podcast, which I'm kind of covering up there. But that is another place that I put educational content on there for you to just stay updated, just with different topics, financial literacy topics as well. So hope you guys all have a good rest of your day. I hope this was helpful to you in trying to have a comprehensive overview of what's happening in the market right now. Let me know if you have any questions or anything you would like me to address in future market updates, and we'll talk soon. All right, thanks.